Markets, though, first, with the Dow at new session highs pretty much after some interesting comments from Austin Goolsbee in the past hour, maybe showing a little more openness, or he's been typically considered somewhat more dovish, but kind of reiterated his concern about the banking system. The S&P's up 1/3%, the Nasdaq still down by 10.
All right, let's check in with Christina Partsenevelis, who is in studio for a look at some of the movers. Welcome, Christina.
Thank you, Tyler. Well, unfortunately, the Nasdaq's on a roll for 5 days in the red out of 6. The Dow is the only consistent index right now over the last week or so, up about 1%. You got worries about inflation, which the CPI report is out tomorrow, and then the start of bank earnings on Friday. And the banks, speaking of them, are certainly taking a bearish tone on the economy. Wells Fargo calling for a 10% correction in the S&P 500 over the next 3 to 6 months, while Citi is worried about a credit crunch due to tightening financial conditions post Silicon Valley Bank fallout. Let's talk about some names, though. Heavyweight Microsoft, you can see shares down 2% after UBS trimmed its estimates for Microsoft Cloud service Azure. They say migration to the product has been pretty slow, so that's part of the reason why they downgraded the stock. CarMax shares, though, surging higher after earnings nearly doubled estimates. So it was at 44 cents a share versus the 24 cents estimate. That's the biggest earnings beat since late 2009. But unfortunately, it's not necessarily because of demand, but because of cost cuts. Shares are up 10%, and the year of efficiency continues. Lastly, shares of Snowflake selling off. We got a downgrade from Midwest Boutique, but there was also a recent company, company insiders, I should say, including the co-founder, selling stock, and it was only revealed in with the SEC yesterday. Insider selling is sometimes seen as a bearish signal for the stock, and that's why contributing to the sell-off, down 5%.
All right, Christina, thank you very much. Christina Partsenevelis. All right, focusing in now on the tech trade, the Nasdaq has been the center of outperformance this year, up 15%. But something seems to have changed in just the past week as the index now, as Christina pointing out, pacing for its 5th negative day in 6. Components like Tesla up more than 50% despite having to cut prices, but down more than 10% so far in April. While mega caps like Apple up more than 20% this year, but slumping recently. So has the positive sentiment on growth and tech this year peaked, for now at least? Let's bring in Bernstein senior analyst Tony Sacconaghi for his tech take. Tony, as always, good to have you with us. I'll start with that general question. Is tech and growth, are they taking a breather?
Good afternoon, Tyler. I think they are. We've had a spectacular tech run-up year to date, as you mentioned. And when we look at technology valuations, they're trading at collectively at about a 40% premium to the market. The historical premium for tech is about a 25% premium to the market. And yet tech earnings this year are actually supposed to grow more slowly, and revenue is supposed to be more slow than the broader market. So you have elevated valuations and you have expectations for weaker relative growth for technology. And I think as we get into earnings, investors are processing that and pausing and saying, look, does it continue to make sense in an environment where the macro is questionable and where we have relatively elevated valuations and some questions about the relative growth rate?
So that's the broad sort of 50,000-foot view. Let's bear down on a couple of stocks that you follow that are very popular in a lot of people's portfolios. They probably own them if they own mutual funds. They certainly own them if they own index funds. Let's start with Apple and your thoughts there.
Sure. So, Apple is an incredible company and has a dominant consumer franchise. As an investor recently very articulately said, they have a monopoly on the most important thing, or nearly the most important thing in most people's lives. And that's a pretty powerful franchise. That said, if we look at Apple's valuation, it's trading at about 28 times this year's earnings. The market's a little bit around 20%. So we're looking at a 40% premium, which is about the highest premium that Apple has ever traded at. And this year, consensus expects revenues and earnings to go down. Apple had a spectacular last few years. I think this year and potentially next year will be digestion years. So you have the same dynamic that's happening in the overall market, which is you have Apple at nearly its peak relative valuation of all time, and yet you're going to have more muted growth this year. And so I think investors are trying to assess that trade-off.
So, Tony, this is such an interesting point because obviously one of the reasons why people were in tech was this idea that you want to be with the growers in a lower growth environment and that kind of thing. Is it possible that tech's just going to take the year off and then go back into revenue growth leadership or earnings growth leadership, because this year they're just kind of catching up to the downside like they led on the upside post-pandemic? So if people stick with the stocks, will they be rewarded over the next 24 to 36 months, even if they're not in the near term?
Right. Well, I think it's a great question, Kelly, and you're right. So for this year, tech earnings and revenue growth are supposed to be below the market. For next year, they're supposed to be above the market. But what's interesting to me is when we look out 5 years and we look at tech earnings growth over the next 5 years, it's about a 2% premium to the market. Historically, the 5-year growth rate for tech is at a 4% premium to the market. So again, when we look out near term, the next year, and longer term over the next 5 years, earnings and revenue expectations for tech are more muted, yet we have these elevated valuations. And that is something that does concern me as we look beyond just the near-term trade on technology.
Yeah, sure. So obviously Apple is kind of a unique case because of the hardware component and pandemic demand. Let's broaden it out a little bit, though. I mean, I don't know if you want to speak to Amazon, but across mega cap tech, do you think that they all are going to follow the same kind of patterns or not here?
Well, I think that's a really big question for the market going forward. What we've seen historically is that technology market leaders change every decade or 2 decades. When we look at the 10 largest technology stocks by market cap at the peak of the bubble, 1999, 2000, only one of them is in the top 10 today, and that's Microsoft. All the others are no longer great stocks, and 7 of the 10 largest stocks at the peak of the tech bubble, they've never gotten back to their peak valuations more than 20 years ago, which reflects sort of how dynamic tech is. So that's the real question is when we look at the growth rates, the expected growth rates for Amazon, for Microsoft, for Google, for Facebook, for Apple going forward, they're dramatically lower over the next 2 years than they were over the last 3 or 4 years. And that begs the question of whether they will be able to sort of cyclically improve or readjust their business models to have sustained growth. Historically, that has been difficult for large cap tech to sustain leadership over 10, 20, 30-year periods.
We don't want to let you go without getting a quick, and I do have to underline, quick thought on Tesla. All I see as I drive around northern New Jersey are Teslas. I mean, they are everywhere. But if you look under the hood, or in the case of Tesla, the frunk, because it really doesn't have a hood per se, you seem concerned about some of the numbers, specifically about market share declines in the U.S. and even maybe more notably in China.
Correct. Yeah, so look, Tesla is a great company and had, I think, a first mover advantage in the electric vehicle market. And so they've grown tremendously to their credit, and they're still growing tremendously. But their goal is to grow at 50%. Last year, they grew a little under 40. This first quarter, their deliveries were up 36%. And they're starting to grow more slowly because we are seeing more competition and we are seeing market share losses as more EVs enter the market. This year, we expect 180 new electric vehicles to debut globally in terms of new offerings. And that heightens the competition, and Tesla doesn't really have anything new this year. So we're seeing pressure on their growth rate, and the company is responding by lowering prices.
Tony, always great to hear from you. Thank you for your time and sharing it with us today. We appreciate it.
Thank you, Tyler.
Tony Sacconaghi.
Let's take a look now at United Health. As everyone looks forward to earnings season with the big banks, well, an even bigger company reports on Friday, and a big day for United Health, which is one of now the largest market cap companies in the United States. $483 billion, in fact. It's bigger than JPM and Citi combined, and it's had the largest impact on the Dow, which is a price-weighted index. Healthcare as a group has more weight in the S&P than the financials. Joining us now to preview the stock, John Ransom is Managing Director of Healthcare Equity Research at Raymond James. John, it's good to see you. And first of all, healthcare is not exactly a cyclical type of trade. So we don't look to United Healthcare maybe as a bellwether or as a tell for the rest of the space, or do we? What's at stake here?
This group, the difference between the volatility in earnings and the volatility in stock price is quite remarkable. United Healthcare never misses. So you can dial in 13 to 16% EPS growth for the next 3 years, and they really won't miss that. Very unlikely. But what is volatile is the price that people decide to pay for it. That jumps around quite a bit. And what we found is that we think investors generally overreact to regulatory fears, and when they drive the multiple down, that's the time to buy it. So we, as you know, we upgraded it last week because there were some perceived regulatory fears in Medicare Advantage that got a lot better. And so that was a clearing event, and this is frankly one less thing for people to worry about.
Sure. So, I can't help but think when I listen to the certainty about it that must be the end of the certainty. That this Friday they're going to miss or something, right? How long can trends and streaks like this really continue? Or is that what happens if you're effectively, a government utility to some extent?
Well, we did this analysis a couple of years ago, and we calculated that 90% of the growth in United is either the 4% from capital deployment, either M&A or share buybacks or a combination. And the other part comes from Medicare Advantage. So if United Health is going to get in trouble, it's going to be because they miss in Medicare Advantage for some reason, or the government moves their cheese. But absent those two facts, that's 90% of the story. And they're just coming off a year where they spent $21 billion in M&A, and that's going to be a cold spring probably for 24 and beyond. And then, like I said, we did have some concerns about Medicare Advantage rulemaking. But the rules got better than what was feared when the stock was troughing.
I don't think many people know that United Health is the third largest Dow component. I don't think many people understand that its price in the 500s, in that price-weighted index, gives it incredible influence on what the Dow does in any given day. I'd like to hear you comment about that, number one. And number two, answer a kind of sophomore economics question or finance question. Is this a stock that might split?
I don't think professional investors spend a ton of time thinking about the Dow because it is price weighted. There's not a lot of money indexed to it. So they spend a lot more time thinking about the S&P than the Dow. So I'll leave that to people who focus on the Dow. In terms of a price split, I think that's actually a good idea because, at the margin, you could get more retail interest if the stock was, 10 times lower than it is today. So, yeah, it is. As weird as it is hard to think in terms of $30 in earnings and $500 in stock price. People would much rather think about $100 stock price, in numbers that are 1/4 or 1/5 that size. So I think that's actually a good thought. We have not heard anything about that from the company, but it wouldn't surprise us.
You made me feel so good there, John. I had a good thought. It really makes me happy.
You did.
Thank you, John. Appreciate it. John Ransom. Coming
All right,
up.
thank you.
I'm going to keep that streak going with good thoughts. Speaking of the health space, shares of WW, the former Weight Watchers, they're soaring today, all on hopes that weight loss drugs will usher in a new era for the company. Meanwhile, shares of Moderna falling after the company updates the markets on several of its vaccines. Health and money, two of the big topics. They're ahead on Power Lunch.